Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, October 21st, 5:27 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at key levels for next week, and update the world-famous 21 over 21 list. Let's dive right into it. Nice to see some green on the agenda, especially the change from the market state going from correction to correction with a short-term uptrend, as we did in fact get a follow-through day today on the major indexes, primarily the S&P and the NASDAQ 100. Now, volume is pretty much always heavier on days like today because of options expiration, but nice to have. So, I mean, maybe you got to put a little bit of an asterisk next to it with the volume coming in at the end of the day, but definitely, a follow-through day with the strength that we saw, and this is what you're looking for now. We're certainly not out of the woods yet, but let's put it this way: no rally has ever started without a follow-through day. It's really that simple. It helps put another check in the column of bull versus bear. We had one of the differences of the prior follow-through days that we had in this bear market rallies that failed is that we had stocks breaking out of good bases with volume and plenty of leaders to pick from. And that's what bear markets are for. They lay the groundwork for the next uptrend. Stocks that held up, we've been keeping our 21-21 list updated every week. And those stocks built bases and have either come to the top of the base or had good reactions to earnings or broke out. And we'll go through them all when we go through charts and the tail of the tape. So what happened today? Well, first of all, trend gauge you can see over here. Market leaders still neutral. We want to get this follow-through day cemented a little bit, but the arrow pointing over toward bullish/uptrend. Short term, all of the indexes have now had at least one close above their 21-day exponential moving average. We don't go to bullish until we get two closes and a higher high above the 21-day exponential moving average, but the sub arrow very clearly green. The next hurdle for bulls to overcome will be the downtrending 50-day moving average and the downtrending 200-day moving average. Those are our medium-term and long-term trend indicators, and they still are both bearish/downtrend, but we're coming up to them quick because they've been downtrending for months now, and that puts them closer to price. It means they'll get tested sooner. The long-term 200-day moving average is 8% below its peak. That means if we re-enter based on that part of our capital, we'll be re-entering 8% lower than the peak on that. So that's one of the benefits of bear markets, is that you preserve capital. You can get in pieces as long as the market starts well and continues well, and we'll just continue to check off boxes in the plus column and move the minuses, the negatives, over to the positive column. And we'll continue to climb the wall of worry. Everybody, Bloomberg this week said 100% chance of a recession next year. But there was a headline today, right at 9 o'clock Eastern time, that sparked this uptrend. And we'll talk about that when we go through the tail of the tape. So very green. G6 up 2.2%, S&P up 2.4%, NASDAQ 100 up 2.3%, Dow up 2.5%, mid-caps up 2.1%, Russell up 2.2%. So broad participation among the major indexes. Global Diversified 60/40 up 1.35%. We dipped further into the market. We were up 0.88% on the day, and we're positioned now for more upside. We've got three of what we consider to be the leading stocks and a 30% index long via a enhanced ETF. We'll go through that when we go through the portfolio changes on the tail of the tape. And now let's get to why we do what we do at Revere, and more importantly, how we do it, what we do it. So here's the S&P 500. which is a chart of the highs, lows, and then closes of going back to last October for a year of the S&P 500. And the three lines that we track, actually there's fourth, there's an ultra short-term line on here, the ADMA. But basically what we do is we see where the price is on the major indexes versus our trend indicators, the green line, the short-term 21-day, the red line, the medium-term 50-day, the black line, the long-term 200-day. And why we do what we do is all bear markets, and we want to avoid these. This is very clearly what our goal is at Revere, is to avoid these big drawdowns that drain your financial capital, your mental capital, your emotional capital, and there are signals that we follow to get out of the way and avoid these bear markets. We especially want to avoid severe bear markets because of the concept of a negative sequence of returns. It just puts you at the mercy of the market. Market doesn't care when you're retiring. It's going to do what it's going to do. The last thing you want, and we want for our clients, is to have a big loss right before we retire that was going to impact our quality of living in retirement. And when we put our rules in place to exit and to get back in, why do we exit? Because on a severe bear market, 6 of them since 1968, average loss 44.5%. You need 80% to get back to even. Nobody's going to tell me that that's not going to impact what's going on with your retirement, just because the markets at some point will recover. You don't know how long, you don't know even when. I mean, we are a ridiculous amount of money in debt. We've got on the brink of a sovereign debt crisis. We've got inflation that's not under control. We've got rising interest rates. Sometimes the magic wand doesn't work the way it has in the past, and that's what we're here to protect against. So if you're interested in an approach like this, give me an email, don@revereasset.com. You can also email my partner and Revere president, Dan Stewart, dan@revereasset.com. He's a CFA, and we'll talk all things financial with you. Or you can call 855-REAL-WEALTH. That's 855-732-5932. We have had a fantastic year for new clients coming on board. And a lot of it is because we got exposure in June to a new avenue through Trader Lion Richard Moglen's podcast that he does on YouTube, interviews that he does, and it resonated with a lot of people. And then, we rallied. A lot of people are not really concerned when the market's rallying, and then we rolled over again. And this is when we really start getting the phone calls, when people see and we discuss the rules for entry, the rules for exit, what can happen if you don't protect yourself. And it's been we're very happy that our message is getting out there and resonates well with somebody who's is open-minded enough to allow a common sense approach to be applied to the markets. After all, that's how you treat every other aspect of your life. So when we're trending higher than these, like we were last October, everything's fine. We're as long in the market as we can be. That means we have as much money in stocks as we're comfortably doing. If things start to roll over a little bit, our stops will get hit. It'll take us out of the market. If things really start to roll over and the slopes of these lines roll over, that's when you really got to start paying attention to what's next. And if you break below this black line, the 200-day moving average, that's when it's time to really get defensive, because all of these bear markets, every single one of them, not just the severe ones, takes place below the 200-day moving average. The average drop from the high till a break of the 200-day moving average is about 12%. The average of those severe bear markets was 44%. So you save yourself 32% of additional pain in these severe markets by staying out of the way. And then when if things start to get better, we've got rules for re-entry, such as undercuts of recent lows and shakeouts. Those happened several times here. Some of them worked for a couple of weeks. Some of them worked for a couple of days. Some of them worked for a couple of months. That's what we're operating right now, is this big shakeout and recovery last week on perceived bad news on inflation, CPI, that just washed everybody out that wanted to get out. And now we've just been little by little working our way higher. There have been some fits and starts in there, some big shakeouts, some bear traps, some bull traps. But the bottom line is today we had a follow-through day, big volume up. leading stocks working well, back above the 21-day moving average. That's our green line. We put more money to work when we're above there. So basically, we put some to work with the false breakout. We'll put more to work on the move back above the 21. Leading stocks continue to work. We'll put more to work. We get back above the 50. We'll put more to work. We get back above the 200-day. We'll be basically the equivalent of all in, as long as we can be in the leading stocks in the leading sectors and the market indexes. That's how we roll. So here's the S&P 500. What happened today? I talked last night in the video that although we broke back below the 21 and there was a very obvious bull trap here with the early rally, and this happened 4 times this week: early rally, fade, early rally, fade, early rally, fade. It happened again today. So overnight, we were down 0.8% at 8:59 a.m. this morning. I had my call with Dan, then I have a call with everybody. And right when we started the call, Michael said, "There's just news that hit the wire that jolted the futures from down 0.8% to even." And that was a story in the Wall Street Journal that, quoting unnamed sources, that the Fed was going to raise 75 basis points, and then they were going to evaluate whether or not, how much they would raise going forward, because there's been a lot of people calling for them to not kill the economy. A lot of people saying maybe a little bit of inflation we can live with, as long as people don't lose their jobs and businesses and the consumer's still spending. And this was the first sign of dovishness, and the markets took off to the upside. Then they pulled back before the open. So we actually opened down about 0.15%, but boom, shot up immediately. By 10 after 10, we were up a decent amount, and it was looking like we were going to go to the upside. But what happened here? Same thing that happened 3-4 times this week. We got right into the 21-day moving average, and we failed. We didn't add any exposure yet. Actually, we did. We added to AEHR. I talked about this last night, one of the 2 strongest cancelim type stocks in the market. So we added to our position there, and then we watched the market. And what did the market do? The market failed into the 21-day moving average, which was at 37.08. So we're like, oh great, here we go again. Shortly after that failed, and we broke below 3,700, we took some more exposure off our last third of our VTI position, sold it on the failure coming in. It's been consistent with what had been happening. And then we waited to see what would happen, and the market pulled back, but the market stopped going down at 36.68. It held yesterday's lows, and then we started going back higher again. We're like, okay, seesaw. That was a bull trap. Is this a bear trap? We're going higher now. We made a higher high, and then we reversed. Now here's the key area right here, and we were reviewing it. This was right when the podcast was going on. Today, right before our podcast. The podcast starts at 12:30 Eastern time, and this little pullback right here and the inability to break below this 3,700 area, 3,700 to 3,710. We've been talking about this 3,700 area on the tail of the tape. 37.08 was where the 21-day exponential moving average was. So this was a prolonged period, about 20-30 minutes, where we tried to push back below the 21-day exponential moving average, and we couldn't do it. We saw that as a very positive sign, and then we started going off to the upside again. And this coincided with Netflix. I'm going to talk about this in a little bit, breaking above the 200-day moving average, as if basically just what we talked about we were looking for in last night's video, and we bought it. And then we based again, and we continue to go higher, and we added to our UPRO twice on here, taking it from a 5% to a 10% position, and basically undoing the selling that we did. It's okay if we're wrong. We don't care if we're wrong. We'll turn around on a dime if the market shows the right characteristics. So we brought UPRO up to a 10% position. That's the equivalent of 30% in the S&P. And then we doubled up Netflix when we hit our ATR plus 0.25%. That's our pyramid level. We added to it again, so now we've got 6% in Netflix, and then we just let it play out for the rest of the day. Every pullback was bought. This pullback was bought at 37.20. This pullback was bought at 37.30, and a little flag into the close. Couldn't really ask for a better afternoon if you were a bull. We took advantage of that to put some more money into the market and to get positioned for, we knew it was going to be a follow-through day because we knew the volume would be there because of OPEX, but we were also seeing good action in leaders, a lot of them in buy points, some good action in stocks, and some volume going into it from the screens that I was running. Volume has been non-existent in leaders or stocks trying to be leaders during the bull market. Any bull market rally that we saw during, or attempted bull rally during this bear. So it was good to see that, and our beta is over half of what the market is now, and we're ready for more if the market continues to go higher. We've got our list. We'll go through the 2121 shortly, and we're feeling pretty good, feeling better than we have, let's just say, in a while. And those things, those 6 signals that I talked about last night, they all kind of held up and did what we would have wanted them to do. So we took advantage of it. It's a preparation meeting opportunity, I guess you could say. So here's the NASDAQ 100, and guess what? It even broke out of this little bull flag and closed above the 21-day moving average for the first time in this one time it poked its head above back in early September. So this was a bullish engulfing, means the lower low and a higher high. Versus the prior candle and a close above the 21, so good stuff there. Dow Jones Industrial Average also participated. Strongest of the stocks, look where this came into, the declining 50-day moving average. So this is going to be the first test of any of the moving averages versus the 50-day since we broke the 50-day back here on 9/13. So we'll be certainly keeping our eye on that next week. Value and growth were fairly split evenly today. It wasn't one or the other that led, but beaten down growth did not do well, as ARK-K was only up 1.8% on the day. So there's the Dow. Let's look at mid caps. Mid caps have been taking a little bit of a beating the last 3 days. Got back above the 21-day moving average, so first close there, and then small caps IWM, first close above it there. Now, this was helped very much by the dollar coming off. We read later that Japan intervened and bought a bunch of yen, which may have artificially brought the dollar down, but ultimately we'll see how this plays out. But for now, it's a close below the 21. We weren't able to break the 21 earlier this week. And back here on 10/4, we had one close below the 21. Back here on 9/12, one close above the 21. Let's see what happens with the dollar. We know what the correlation has been: weak dollar, strong stocks; strong dollar, weak stocks. Then we've got TLT. We had the yield curve got less inverted today, and by that I mean that long-term bonds sold lower, which means the interest rate went higher, so the interest rate making an all-time high there. But the 10-year and the shorter durations, the yield came off. In other words, the price was higher. So this is actually the second candle in an evening star pattern. An evening star is when you have a long uptrend and it just gets exhausted and reverses at the end. To confirm it, you need a close halfway inside yesterday's candle, so we'll be keeping our eye on that. And then see how that plays out. As you know, this has been riding the ADMA up for months, so we got to keep an eye on that. And both of those things are good for stocks. So that was certainly beneficial to what was going on in the market. Those correlations are very key to the continued strength in the market, and we'll be watching them closely. Let's take a look very quickly at what Bitcoin did. Not much, up 1% on the day, but it and also what did gold do? Gold, with the dollar down, gold was up 1.8%. So didn't make a lower low on this last pullback. Let's see if, but honestly, we have no interest in gold. As long we only really get interested in gold if it's by far outperforming what's going on in the market. There are times when that happens and times when it doesn't, but really both times are completely dependent on what's going on with the dollar. And this has had ups and downs similar to what the market, but not as much strength as the market. So there's no reason to be in it when there's better places to be found. So let's bring up the tail of the tape now, and then we'll get to the 21 over 21 list. So obviously correction, we added short-term uptrend. The technical indicators hooked up, so that's a benefit now. I can get rid of this failed comment. Also, the NASI McClellan Summation Index has hooked up. That's to the benefit of bulls also. Put call 095, VIX just down slightly today. Normally would be down more, but it's below that 30 area, which had been stubborn, and second close below the 21-day exponential moving average is also a change in character for the VIX. So two closes below the 21 here and a lower low, again, beneficial for stocks. Fear and greed up another 5. It's in the neutral zone now. So we're split now between the bull case with the follow through day and the bear case, which is still in effect on the 50 on the medium term and the long term. So that's split. I talked about the Wall Street Journal triggering really this follow through day. It was absolutely what lit the candle for it. So we went from our day count went from 2 days down to one up day. Here's the less inverted yield curve that I talked about with the TLT down but shorter duration ETFs and price of bonds up, which means the yields were lower. Expectations were neutral coming in, positive now with the follow through day. We cleared some support and resistance areas here. Areas that had been acting as support resistance guideposts, we cleared them both on the S&P and the NASDAQ 100. Here's that key with that pullback in the afternoon to that 3703, challenging the 21-day moving average. When that held and took off, that was a change in character. It was subtle, it was small, it was on a 5-minute chart, but it was definitely something I was paying attention to. As far as sectors go, 11 out of 11 up. Short-term bonds up, so their yield down. XME up strong, oils up strong, semiconductors up strong, dollar down, long-term rates up, meaning TLT down, and managed futures down. We'll take a look at these stocks when we go through the 21 over 21, the focus list, but we did buy Netflix, we did add to AEHR, and we do own HLIT. We do own an oil ETF, and we have an inverse short real estate ETF, and now a 30% position in the S&P 500. So there's the sell of VTI on the initial failure at the 21, and then, as I said, we added to AEHR early, added to the UPRO when we saw the what was resistance turn to support, hold, and then 2-3% buys of Netflix. And bottom line, Wall Street Journal article on dovish Fed triggers follow through day. Let's look at support and resistance here. So we cleared this level. This was a big level, this 3,700 to 3,730, and cleared the 21-day exponential moving average, which is also in that range. So very good stuff there. We need to, this is the key for next week, is back tests of this, especially the 3,700 area, need to hold, absolutely need to hold. So 21 over 21 list now. Let's go through that first. The 6 stocks that were booted off from last week and why they were booted off. Let's start with BTU. Coal stocks had been leading, but BTU had a rough last 2 days, broke below the 21-day exponential moving average, so it's removed. Humana still above what was removed because if we're going into a bull phase, we don't need 2 managed care stocks on there. There were actually 4 or 5 of them that are acting okay. We kept Molina on and took Hum off. LPLA, I was happy to take this one off because I just, like I said, it's like a lung cancer patient buying Philip Morris. A trend following, owning a pie chart company is just doesn't sit well with me. So, it showed relative weakness today or this week, so it gave me reason to get it off, and there are better opportunities than that. LW, sometimes this closed right below the 21, but this is a case of something that was on, didn't participate in a strong market, and it's a matter of sector rotation. This is a very defensive sector. Packaged foods, really? Their numbers are good, but packaged foods, come on, it's a that's about as defensive as you can get. Nice chart, but is it going to lead the next bull market in growth stocks? I don't think it is. So took that one off. MTB, I already talked about that, but with the big gap down on earnings, this just tells you how fast a great looking chart can just go to hell on an earnings report. Regeneron closed right on the 21, but serious weakness this week. Look at the relative strength line. That shouldn't be anywhere near a leader's list if it's going to act like that. Overall, a good chart, but ask yourself why it hasn't kept up with some of the better looking stocks that we have on this list. So those are the 6 that got punted off. Now the first 6 that I'm going to show here are the 6 that took their place. Let's start with Interactive Brokers. They reported earnings, good reaction to earnings, and follow-up strength. That's everything that you're looking for with a potential leading stock. CEG back on here, had its correction back above the 50 and the 21. Really this just going sideways on a relative strength basis while the market pulled back. So good numbers here. Wanted to get it back on there. Northrop Grumman, I could have had 4, 5, 6 aerospace defense stocks on here. All the thing that lit the candle for that was Lockheed Martin's earnings earlier this week, and they've all followed through to the upside. Northrop Grumman reports in 6 days. Deckers tried to break out, failed breakout, bounced at the 8, had a decent day today, up 4.5% on 61% above average volume. So good stuff today. They do have earnings next week though, but that's a pretty good looking chart. Netflix, now this was one of the keys today. I talked last night about that Chipotle, how Chipotle acted on its last earnings report when it was acting weak, had a big gap up on its earnings report, and then followed through to the upside through the 200-day and went on a nice run. And Netflix with volume got above the declining 200-day moving average today. I understand that there's a lot of overhead resistance here on the left side of the chart, but this is a big liquid stock that can lead, the type of stock that can lead the market higher. And it clearing these moving averages and moving the way it was today, I wanted to participate in it. Here's the 5-minute chart where, first of all, right here, it broke above the prior high of the gap up day. When you break through the high of the gap up day, that's the market saying, we're not selling the strength on this, we're going to continue to buy it. And this is what triggered our initial buy on it. And then on the pullback, the pullback was very shallow, and we took another 3% position on it when we hit our metrics for pyramiding based on average true range. So good stuff on Netflix. And it's an easy stop out if it doesn't work. It shouldn't lose today's lows. So Netflix, thank you. AEHR, we've been talking about this one for a while. Bought it yesterday, bought more today. Very strong, up 11.6%, above 69% above average volume. Broke out of this flat base. It's in the silicon carbide sector. It's got relative strength at all-time highs. It has good volume patterns. It has good earnings and sales. It's, as I said, a great can slim stock. And the only thing keeping us from owning more of it is the fact that it's fairly thin. But you can see how the trend of this line is trending higher, and that's a good thing, and that'll allow us to get more stock with confidence if it continues acting that way. O'Reilly, going sideways, defensive sector, right at the top of the range. Earnings next week. Let's see how this plays out. These typically don't lead bull markets. Texas Roadhouse, pulling attempted breakout of this flat base. Earnings next week. That will probably tell the tale about what happens to this, but a good day today. Scorpio Tankers, look at these up bars and the volume on them, and then a gentle pullback today. Great looking chart. Not real happy that it would be down today when the rest of the oils were up, but can't always get what you want. Here's Hess Corp breaking out. This is very typical of what we've seen with a bunch of the oil stocks today. This is an international. They've got a international explorer and producer. They've got a lot of exposure to Europe, which, as you know, is in an energy deficit. Steel Dynamics, steel stocks really acting extremely well. Great reaction to earnings, follow through on strength today. We got to get into these. If that sector is going to run, it runs quickly and strongly. ExxonMobil, new highs were in this by the ERX ETF that we own. This is one of the top holdings in there. So happy to see it doing that. World Wrestling continues to ride its EMA higher, ADMA higher. This is a case of a stock that has been showing relative strength, and then very often when the market turns, these stocks that were prior leaders was where people were stuffing money to keep it from going down, but not WWE. That made a higher high today, which is pretty bullish. Eli Lilly, good looking medical stock here. Nice pipeline with the Alzheimer's drug, and they also have a weight loss diabetes drug that's pretty popular, and nice candle on this today, up 3.6%, slightly above average volume in earnings in 2 weeks. Initially gapped up based on this Alzheimer's Biogen news back on 9/28, pulled back gently, held to 21, really looking good. Molina Health, MOH, this is the managed care company that we left on here, really just going sideways. Want to see how these play out, but the sector is really strong, so see if it holds up. Dino, one of the strongest of the oil stocks. Nice little pullback here on lower volume after its attempted breakout from this cup and handle. Nothing wrong with that. HLIT, the other stock that I've been salivating over, very thin. Have to tiptoe into it when we buy it, but not very many better looking charts than that. They had a back here in mid-September, they had an analyst day. And it really took off after that. The market continued to pull back. It had a 3-day pullback, bounced at the 50-day, and look at the volume ever since then and the relative strength. So, as I said, that and AEHR are, this is probably 1B. AEHR is stronger. Sarepta, SRPT, forming a nice tight base. It remains to be seen whether or not biotech is going to perform a leadership role in this bull market if it continues. Neurocrine Biosciences, NBIX, another biotech, decent day today, not the best. LNG, Michael talked about LNG again on the podcast. Make sure you tune into that. And Ted had a fantastic presentation on Stan Weinstein's stage analysis, and then gave some examples. I loved it. If I like it, you should like it. There's a reason why you're following us, right? And watching this. So good stuff there. LNG is one. It's not in that ETF or doesn't have a prominent weighting in the ETF, so I am looking to get into this. And Vertex, this is another one, just goes sideways. Not sure if it's going to lead in a bull. It is considered kind of defensive. We'll see how it plays, but you can see the fact that it's number one tells you how long it's been on here. It certainly has been holding the 21, but there's also such a thing as being too tight for too long. So that's going to wrap it. As always, love to hear from you. Email don@revereasset.com. The phone is 855-REAL-WEALTH, 855-732-5932 if you want to talk to Danny. And the key for next week is on the S&P 500 and the NASDAQ 100, and really all the indexes actually, that we hold this beautiful green line here that has now flattened out and is trying to turn back to the upside, very similar to what we looked at right back here. And it would be just fantastic if it could lead off a double-digit rally up to the 200-day moving average, although we're 9% below the 200-day moving average here, so we do have room to run. We'll see what happens. First challenge is going to be the 50-day moving average, which is continuing to come down here. Notice the 50-day back here actually flattened out and turned higher during this last rally. That's what will have to happen today, or during this rally if it gets sustained, but that's what we'll be looking for. But on the downside, we definitely want to hold the ADMA, which is at 3712, and certainly 3700 on any pullback. So wrapping up the week ending September 21st, this is Don Vandenbord telling it like it is. Remember, it's not how much you make in the market, it's how much you keep. Thanks for listening and have a great weekend.